Are you thinking about buying a home, but you're confused about all the different home loan mortgages out there? This video is designed to go over all the different loans that are available to you to make sure that you get the best home loan for your needs. This video is going to go over these different types of loans: conforming loans, non-conforming loans, jumbo loans, FHA, VA, USDA, bridge loans, interest only, and renovation. All these different types of loans, one may not be the best for you, but one will be the best for you to fit your best needs and your options, and that's what we hope to teach you in this video. My name is David Wright. I've been a mortgage loan officer for over 20 years. I'm also a homeowner. I'm also an investor, and I've also made a lot of mistakes in the past that I want to share with you so that you never make the same mistakes. Before we jump into going over loans, just want to go over some basic terminology. We're going to be going over the length of the loan. We're going to go over the terms of the loan. We're going to go over interest rates, APR, and points. Because one of the main things people don't realize is there's a big difference between the interest rate on the loan and the APR. The APR is the total cost of borrowing. The interest rate on the loan is what makes your monthly principal and interest payment. Now, before we jump into loans, let's look at the two basic types of loans. There's adjustable rate mortgages and fixed rate mortgages. Now, adjustable rate mortgages have an initial fixed period of time that they stay with the same payment. A lot of them come in 5-year, 7-year, 10-year, and then after that term, they can adjust upwards or downwards depending on market conditions. Now, there's a lot of pros in these. The pro is you start out with initially a much lower payment, making things be more affordable. But some of the cons are this: depending on at the end of the fixed year term, they could either adjust upward, which could be dramatic, or they may go downwards. But in the current environment we're in, upwards is actually a lot more likely. Now, some of you may remember the movie The Big Short, and that's how some of these loans can have an adverse effect on you and your purchase of your home.
So how many of these are adjustable rate mortgages?
Well, most.
Oh, yeah.
Yeah, I'd say about 90%. Yeah, the bonuses on those skyrocketed a few years ago. Adjustables are bread and honey.
Now, another option that's been going on lately is called the buy down. Since 2022, where the interest rates were higher, lenders came up with a new thing called a buy down. The buy down temporarily buys the interest rate down for a period of 1 year, 2 year, 3 years. Now, the benefit of this is your interest rate is much lower during these periods, but then it slowly resorts back to the original rate. So you really want to consider these mortgages one key thing: can you afford the full payment, not just a lower payment from the rate buy down? Now, fixed rate mortgages, well, these are a lot more simple. They're simply fixed payments for an allotted period of time, which they come in these sort of increments: 15-year, 20-year, 30-year, and even now we're doing 40-year ones, which is probably not the best option. Now, there's a lot of benefits to having a fixed rate mortgage. You have a stable payment, you know what you're getting, and it never changes. Now, the first loan out there, and probably the most common loan, is called a conventional loan. These are loans that are backed by Fannie Mae and Freddie Mac. They come in two different types. They come in conforming loan amounts and non-conforming loan amounts. Each one of those is going to be a different amount depending on the state and county that you live in. So please make sure you look into that, because it does make a big difference for a conforming loan versus a non-conforming loan. Otherwise, non-conforming loan is called a high balance loan, and they're typically more expensive. Now, what's some of the benefits of getting a conventional loan? Well, there's no upfront finance mortgage insurance premiums. You can get away with 3% down, 5% down. The mortgage insurance is typically cheaper on these loans as well. And overall, these loans usually come with a lower cost. They are fixed rate mortgages. And as a bigger picture for the long term, they're very simple and easy to use. Now, here's some caveats to think about if you're getting a conventional loan. So if you have good credit above 700 and you're putting down 5% or more, the interest rates are very good on these loans. Also on these loans, if you're putting down less than 20%, you do have private mortgage insurance, but it is now priced very, very affordable. Overall, your conventional loans are made for people that have a little bit better credit and a little bit better down payment. Overall, they're one of the greatest options you can get if you can get into it. But if you have to use another loan type, there's always one for you. Now, one of the next most popular loans for people in the current market now is called an FHA loan. Now, FHA loans have a lot of different pros and they have some cons, but let's just take a look at the basics of them. FHA loans typically require a 580 FICO score and up. Although you can get an FHA loan with a lower than a 580 FICO score, the down payment will be a little bit different. Traditionally, if your FICO score is 580 or up, your FHA loan requires 3.5% down payment. If your FICO score is lower, it may require more down payment depending on your file. Now, some of the pros of the FHA loan are this. They don't have as restrictive credit policies. You can have some blemishes on your credit report and still get a great loan. And typically, FHA loans have a much lower interest rate than conventional loans. The other thing that is beneficial on FHA loans is they allow you to have more of a, let's say, not perfect work history that we can work with you on, and they have more flexibility on your debt to income ratio as well. Now, there are some drawbacks to FHA loans. Here's some of them let's look at. Well, first, there's upfront PMI, which means there's a 1.75 fee charged up front onto your loan. Next, if you utilize the FHA loan with 3.5% down, your mortgage insurance stays on the loan forever. The only way that you can get the PMI to come down on FHA loan is if you put down a minimum of 10%. Another thing that's kind of a negative on your FHA loan is there is a waiting period of refinancing a loan. Typically, there's 180 days that you have to wait before you're eligible to refinance your FHA loan. But overall, the positives are way more than the negatives. It's a great loan to get into the market, and it's a great way for you to start building wealth in a home. Now, your next loan is your VA loan. Now, there's a lot of great positive things about the VA loan, very few negative things about the VA loan, but just to put this out in front, a VA loan is only for people who are in the military or who have served in the military, and it also can be used by a surviving spouse that was in the military. Now, let's look at some of the great benefits of the VA loan. The interest rates, some of the lowest in the business. Also, they don't have mortgage insurance on VA loans. Also, they have much more lenient credit terms, and they allow a lot more flexibility on your debt to income ratio for overall making the VA loans one of the best ones in the business if you're eligible to get it. Now, if there's one negative to the VA loan, it's simply there's a waiting period that you have to wait to refinance a loan. It's 180 days. And one last caveat. The greatest thing about a VA loan is when interest rates do drop and you meet the waiting period, even if you've lost your job or your income has changed or your whole situation, you're still eligible to refinance and take advantage of the great lower rates that happen. And one last tip, when you're shopping around for your VA loan, don't be lured into different companies that say, I'm a VA specialist, or I'm military home lending, or veterans this or that. You can get much better terms on VA loans if you actually take the time to look around and talk to other lenders and make sure that you are getting the best deal and that you're not being preyed upon by the VA loan, because unfortunately, there's a lot of companies out there that are taking advantage of this, and you don't want that to happen to you. Now, one of the final types of loans in California that we run into a lot is jumbo. So jumbo loans will depend on where you're located in what state and what county. But for the most part, jumbo loans are any loans that are above conventional and specifically above high balance non-conforming loans. Now, these are some of the most restrictive loans in the business. There's tight credit terms. There's tight debt to income ratios. There's no leniency on mistakes on your credit report. They also have reserve requirements, which are payments you have left over after you buy the house. And the interest rates on them are typically not as good as what's called your conventional conforming loan. Now, do a lot of people have to use this loan to get into a home in California? Yes. Does it have great terms overall, fixed rate periods? Yes. Is it a good product? Yes. But you just have to remember, it's a lot harder to get this loan, and it's a lot harder to get a really good deal on this loan. So when you're looking around for this loan, you really want to talk to a couple different lenders, because the rates on jumbo loans are going to vary greatly from, let's say, a bank to a retail lender to a broker. And these loans are rate sensitive. So please take your time to talk to multiple lenders, especially to make sure that you get a good deal, because you're spending a lot of money. Our next loan is the USDA loan. And No, it's not known as a steak loan. That's just a joke. The USDA loan is a loan that's offered by the federal government. It's usually for more agricultural areas, but there are a lot of areas in San Diego that are further away from the city and a lot of areas in Florida that also apply for this. Now, what's some of the great things about this loan? They require 0 down payment. Also, another great thing about this loan, they have very good interest rates. Also, another good thing about this loan is it allows you to get into properties that you would normally have a hard time financing because they are in more rural areas. And one last thing is with the credit terms on them, your credit report, it's not as highly restrictive as well. And it does offer a lot of flexibility to get you into an area where there's typically lowered price houses with a great interest rate with no down payment. Now, the one drawback to the USDA loan, aka the steak loan, is if you're a vegetarian. I'm just kidding. That's not one of the reasons. One of the reasons is it does only work in certain geographic locations. And in the link below, I provided a link specifically to the USDA website so that you can search to see what's available near you and how you can best utilize this product. Because overall, it is a great loan for those people who are looking to get a little bit further away from the hustle and bustle and confusion of city life. Now, our next loan are interest-only loans. Now, these loans, the biggest benefit to them is you're only paying interest-only payments. Typically, these are a couple $100 less than you would normally pay for a principal and interest loan. Now, what sort of loans do these apply for? They actually work with 5-year loans, 7-year loans, 10-year loans, all those different types of arms. There's even some 30-year fixed interest-only loans. Now, why do people use these? They're only really meant to be used for people who are going to buy a property, hold it for 5 to 7 years, gain all the appreciation, minimize their monthly payment, and then sell the home at the end of the term to maximize their cash flow each month and then make money off the appreciation. They're not for everybody, especially if you're planning on buying a house and living there for the next 20 years with your family. Interest only is not a good choice for you. Another type of loan that's designed for homes that aren't in perfect condition, need a little bit of fixing and upping, these are called renovation loans. These are great loans because Fannie Mae and Freddie Mac both do their own renovation loans. FHA does its own renovation loans. What these loans do is they enable you to finance the construction cost of buying a fixer-upper into the house so that you can immediately fix the house up to the way that you want it and start building equity already. Now, these loans do have a lot of details. There are a lot of different things that go into these. So if you want more information about specifically renovation loans, please reach out to me so I can give you all the details. But the overall benefit is this. If you see a home that could normally not get home financing on from a conventional or a non-conforming or even an FHA, look into renovation loans because these loans can fix that problem, get you into the home, start helping you build equity, and have a better home for the long term. Our final loan is a loan for those of you out there who already own a home and you don't want to have to sell your home before getting a new home. These loans that you use on these products are called bridge loans. Now, bridge loans do offer a lot of solutions for people who currently own and they don't want to sell the home before buying the new home, but they need a temporary loan to bridge the gap in the money. That's what these loans are for. There's a lot of different terms on them. There are majority of them all short term, 1 year, 2 year, 3 year, 5 year, and they all have a lot of really good requirements on them as far as what you need in reserves. FICO score is typically around 680 and up, and typically you need a smaller amount of reserves, 6 months to 12 months to get these loans, but it's a great product to help you buy a new home without selling the current home that you're in. You want more information about this? Also hit me up because there's a lot of details that go into this as well. As you can see, there's a lot of things to consider when you're getting the right home loan for your situation. These things are going to come down to your long-term plans of what you're going to do with the home, your long-term plans of your finances. Are you going to be making more money or less money in the future? These also take into account thinking about the right loan for you is how much of a down payment do I have? How much money do I want to keep in the bank? And most importantly, how long do I want to keep the house? Now, if you'd like to get more information or you'd like to subscribe to weekly market updates about interest rates and economics, a video that's roughly 2 minutes every week, please hit the link below and subscribe. And thanks again for watching and happy house hunting.